Stop. Don't look at the Dow Jones. Don't look at the Nasdaq. Look at your phone. Look at your electric car in the driveway. Look at the defensive grid protecting this country. Now, imagine if the raw materials required to build all of them suddenly vanished. For the last 6 months, Wall Street has been holding its breath. We've been waiting for the hammer to drop. Everyone from Goldman Sachs to the retail crowd on Reddit was convinced that this week, mid-January 2026, was going to be the start of Trade War 2.0. We expected President Trump to slap massive, punishing tariffs on critical minerals, effectively declaring economic war on the global supply chain. But yesterday? Wednesday? We didn't get a bang. We got a whisper. And that whisper is terrifying. President Trump just pulled a maneuver that is more complex, more dangerous, and potentially more profitable for the savvy investor than a simple tax. He's not just taxing imports, he is attempting to engineer the global price of reality itself. He's putting a price floor on the building blocks of the 21st century. If you think this is just boring trade policy, you are about to lose money. This is about uranium. This is about the AI revolution. This is about whether the US dollar remains the king of the hill. Today, we are peeling back the layers of this decision to show you why the mineral war just went nuclear and what you need to do to protect your wealth. Let's look at the facts. It is January 15, 2026. 4 months, the Commerce Department has been running a Section 232 investigation. For those of you who don't speak bureaucrat, Section 232 is the nuclear button of trade law. It allows the president to block imports not because of economics, but because of national security. The investigation concluded what we already knew: the United States is addicted to foreign minerals, and our dealers, specifically China, have us by the throat. We expected Trump to come out swinging with 25%, 50%, maybe 100% tariffs on everything from lithium to dysprosium. Instead, he paused. In a proclamation released yesterday, Trump announced he is holding off on immediate tariffs. On the surface, the mainstream media is calling this a de-escalation. They're saying Trump is blinking because he doesn't want to upset the delicate trade truce he signed with President Xi last fall. But if you read between the lines, this isn't a retreat. It's a siege. The president stated he is seeking to negotiate agreements to ensure supply. But here is the kicker, the phrase that should make your ears perk up: price floors. He is threatening to impose minimum import prices. Why does this matter? Because tariffs are a blunt instrument. They just make things expensive for you, the consumer. A price floor is a surgical weapon. It is designed to stop China from doing what they do best, flooding the market with cheap supply to bankrupt American mines before they can even open. Trump is effectively telling the world, we are going to artificially set the price of these minerals high enough so that American and allied companies can actually make a profit mining them. This is the end of the free market in commodities. This is the beginning of managed trade. And for your portfolio, it changes the rules of the game completely. Let's rewind a bit to understand the stakes. Why the hesitation? Last fall, late 2025, the US and China agreed to a fragile truce. Both sides pledged to lower import taxes and ease export controls. The global markets rallied. The S&P 500 hit new highs because everyone thought, okay, the trade war is over. But the administration knows the truce is built on sand. China processes over 80% of the world's rare earths. They control the supply chain for the magnets in your hard drives, the guidance systems in Raytheon's missiles, and the batteries in every Tesla and Ford. Last year, during the dispute that preceded the truce, Beijing briefly choked off access to gallium and germanium. Do you remember what happened? Semiconductor stocks wobbled. Tech supply chains panicked. By holding off on tariffs today, Trump is trying to avoid giving Beijing an excuse to pull that lever again immediately. He's buying time. But the Section 232 authority is still there, loaded and ready. It's a gun on the table. The proclamation explicitly says, it may be appropriate to impose import restrictions if satisfactory agreements are not reached. Translation, play ball, or we shut the door. But here is the economic reality that no one in Washington wants to admit: we have almost no domestic production. If you slap a tariff on Chinese minerals today, you aren't protecting an American industry. You are just taxing American companies because there is no American alternative yet. You can't protect a baby that hasn't been born. And that is where the price floor strategy comes in. This is crucial for you to understand because it's going to affect the cost of goods sold for every major company in your ETF portfolio. Normally, in a trade war, you use anti-dumping duties. If China sells steel for $50 when it costs $80 to make, the US adds a tax to bring it back to fair value. But this situation is different. China isn't just dumping. They have a structural, massive advantage. They have the mines, the refineries, and the lax environmental regulations that allow them to produce critical minerals at a price point that no Western company can match. If a US company wants to open a rare earth mine in Nevada, they have to deal with the EPA, labor unions, and high energy costs. Their break-even price might be $100 per unit. China sells it for $60. If Trump just puts a tariff on it, the price goes to $80. The US mine still goes bankrupt. So, the price floor idea creates a minimum standard. The US government says nothing enters this country under $110. Suddenly, that mine in Nevada is viable. Suddenly, a mine in Australia or Canada, our allies, is viable. This is a tactic to build a freedom supply chain. It's global engineering. It's the US government picking winners and losers on a planetary scale. Nick Iacovella from the Coalition for a Prosperous America called this a massive win. He says it gives manufacturers the confidence to invest. And he's right. If you know the price won't collapse because of Chinese flooding, you might actually build that refinery in Texas. But, and there is always a but, who pays for that difference? You do. Now, let's pivot to the sector that is flashing red on my terminal, uranium. The proclamation specifically highlights uranium as a critical mineral the energy sector relies on. Why is this specific rock so important in 2026? 2 letters, AI. We are in the middle of the greatest build-out of data centers in human history. Microsoft, Google, Amazon, they are building server farms that consume as much electricity as entire cities. The grid cannot handle it. Solar and wind are too intermittent. The tech giants have realized that the only way to power the AI revolution without crashing the grid is nuclear energy. But here's the problem. Where does the uranium come from? Kazakhstan accounts for the majority of the world's uranium supply. Who is Kazakhstan's neighbor? Who has massive influence over their logistics? Russia and China. The US is trying to rapidly build out nuclear capacity to feed the AI beast, but we are reliant on geopolitical rivals for the fuel. By threatening price floors and tariffs on uranium, Trump is trying to force a domestic uranium boom. He wants to see mines opening in Wyoming, Utah, and Arizona. If you are holding uranium stocks, or ETFs like URA, this news is a double-edged sword. 1. The bull case, a price floor guarantees high prices for Western miners. Stocks like Cameco or US-based aspirants could see their margins explode. 2. The bear case, if the US shuts out foreign supply before domestic mines are ready, we get a fuel shortage. The AI rollout stalls. Tech stocks take a hit because they can't get the power they need. So, how does this land in your lap? Why should a graphic designer in London or a dentist in Chicago care about price floors on neodymium? Because this is the return of structural inflation. For the last 30 years, we exported our inflation to China. We bought cheap stuff, made with cheap labor and cheap minerals. That era is dead. It is buried. If the US government forces the price of raw materials up to support domestic industry, the cost of everything goes up. Electric vehicles? More expensive. Smartphones? More expensive. Green energy transitions? Significantly more expensive. This is what economists call greenflation or security inflation. We are paying a premium for national security. If you are invested in the S&P 500, you are heavily exposed to companies that rely on these supply chains. Apple, Tesla, Nvidia, these companies live and die by the availability of processed minerals. If Trump's gamble works, we get a secure supply chain in 5 to 10 years. If it fails, or if China retaliates by cutting off supply tomorrow, we are looking at a supply shock that could rival the 1973 oil crisis. Imagine the 1970s, but instead of lining up for gas, companies are lining up for chips and magnets. Factories shut down. Margins collapse. We have to look at history here. Some trade lawyers are comparing this to the Smoot-Hawley tariffs of the 1930s, arguing that protectionism will deepen a global recession. They argue that by artificially raising prices, the US is making itself uncompetitive. But the administration is looking at a different history book. They are looking at World War II. They are looking at the arsenal of democracy. In 1940, the US didn't care about the efficient market price of rubber or aluminum. We cared about having it. Trump's team is betting that the world has shifted from an era of just-in-time efficiency to just-in-case security. They believe that investors will reward companies that have secure, American-made supply chains, even if they cost more. This is a fundamental regime change for capital markets. There is another layer here, the legal safety net. The prompt mentions that using Section 232 is a way to rebuild the tariff regime if the Supreme Court strikes down Trump's other global levies. This is 4D chess. Trump is fighting battles on multiple fronts. He has his broad tariffs, which are currently being challenged in court. If the Supreme Court rules that the president cannot just tax everything because he feels like it, Section 232 is his backup plan. The courts have historically given the president immense power when he utters the words national security. By framing these mineral tariffs as a matter of national defense, he is insulating his trade policy from judicial review. For investors, this means volatility isn't going away. Policy risk is now a permanent feature of the US market. You cannot analyze a stock anymore without analyzing the legal and political framework it operates in. So, where do we go from here? As we move through 2026, I see 3 scenarios playing out. You need to decide which one you believe in to position your money. Scenario 1, the Fortress America boom. The price floors work. Western mining capital floods into the sector. We see a massive boom in mining stocks in Australia, Canada, and the US. China grumbles but doesn't retaliate fully because they need our agricultural exports. Winner, domestic mining caps, defense stocks, US industrial stocks. Loser, Chinese exporters, companies with zero supply chain diversification. Scenario 2, the stagnation trap. The negotiations drag on. Uncertainty kills investment. Companies don't build mines because they are afraid Trump will change his mind or a new president will scrap the floors in 2029. We get higher prices but no new supply. This is stagflationary. Winner, gold, commodities. Loser, growth stocks, consumer discretionary. Scenario 3, the trade war nova. China views the price floor as a violation of the truce and decides to remind the world who is boss. They restrict exports of gallium, graphite, and rare earths immediately. Prices skyrocket 300% overnight. The US tech sector takes a massive hit. Winner, put options on the Nasdaq, physical precious metals, maybe Bitcoin as a chaos hedge. Loser, everything else. Let's wrap this up. Wednesday's proclamation wasn't a non-event. It was the quiet setting of a trap. The US government is signaling that the era of cheap, Chinese subsidized inputs is over, and they are willing to manipulate market prices to make that happen. For you, the investor, this means the easy money era of buying an index fund and forgetting about it is getting harder. You need to look at your portfolio. Do you own companies that are completely dependent on Chinese supply chains? You are exposed. Do you own commodities or the companies that mine them in safe jurisdictions? You might be sitting on the next gold rush. This isn't just about rocks. It's about the hardware that runs the modern world. The United States is trying to rebuild its industrial skeleton from scratch. It's going to be expensive, it's going to be inflationary, and it's going to be chaotic. But chaos is a ladder. Keep your eyes on the uranium spot price. Watch the negotiations with Canada and Australia. And most importantly, do not assume the trade war is over just because the tariffs didn't hit yesterday. The war has just moved underground. If you found this breakdown valuable, smash that like button, it helps the algorithm find more people who need to hear this truth. Subscribe and turn on notifications because the moment China retaliates, we will be live to break down what it means for your money. I'm Boss, and I'll see you in the next one.